Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Much has changed in the past 5 years since the official beginning of the pandemic. But one of the most significant differences is in the property market. House prices have soared in the last 5 years, along with rents. And it's not just in the capital cities. It seems every part of the country has been on a rollercoaster ride over the last 5 years or so. Tim Lawless is Head of Research for CoreLogic. Tim, welcome back to Fear and Greed.
Thanks again, Sean. Great to be here.
So, I said soared. That is probably not quite right. Home values have risen by nearly 40% since the start of the pandemic. But, those early days wasn't the case. We actually we've had a couple of cycles almost in that 5-year period.
Yeah, it's been a really volatile 5-year cycle, if you want to use that term. If you remember back in the early days of the pandemic, there was a lot of fear that the sky was going to implode upon us. And we did see values fall over that first 3 months up to about June of 2020. They fell by about nearly 2%, so hardly anything. But then they just absolutely rocketed as all the fiscal and monetary policy support came through. Everybody realized it was probably a pretty good time to get into the property sector.
And then we had that big dip where some cities particularly lost more than 10%.
Yeah, that was through the early part of the rate hiking cycle. And this was really interesting. Some markets peaked well before interest rates started to rise, like Sydney and Melbourne. Both of those markets peaked in early 2022, really highlighting just affordability challenges were becoming pretty predominant after a really strong phase of growth. Both those markets had also seen a real exodus of residents to other states, so interstate migration had really plummeted. But other markets like Perth, Brisbane, Adelaide, they hardly even saw a hiccup as interest rates started to rise, particularly Perth, and those markets continued to rise and just accelerated into 2023. So yeah, I think diversity and some extremes were the themes through those phases of the market.
Just following on from what you said then, I've always thought that interest rates are the ultimate determinant of housing markets. Is that the case? Is it the fact that in some cities, interest rates are far less important than perhaps other cities?
Yeah, they're generally a really important factor in the market, but there's also a lot of other factors that tend to influence housing markets. And I agree, there's probably markets that are more sensitive to changes in interest rates as well. So go back through the cycles historically, and you can look at things like the macroprudential policies that were implemented between about 2015 and 17, and then the Royal Commission. That really tightened up credit availability and resulted in a drop in housing values at a time when interest rates were very low. Or you can look back to, say, a shock like the global financial crisis. You can look towards periods of extreme population growth that really drove housing prices as well. So there's a lot of things that tend to influence prices. And I think the fact that we saw the market lifting quite broadly in early 2023 after a pretty short and sharp downturn just highlights the importance of supply as well. So that growth phase occurred against a backdrop of very low supply levels, both from an advertised supply and a newly built supply perspective, that just ran headlong into a demand shock as overseas borders reopened. And we still had this, challenge of very small household sizes that had become a thing through the pandemic.
Never before had I thought about tree changes, sea changes, regional values as much as I did during COVID and post-COVID. What happened there? And initially there were gains, certainly, but have they been maintained?
Yeah, that was just remarkable. And I think it really highlighted people still had this love affair with coastal markets and, even just hinterland and tree change markets as well. We did see markets that were very high-profile lifestyle regions like Byron Bay, the Southern Highlands, the Gold Coast, the Sunshine Coast. Ballarat was certainly a recipient, the Surf Coast, of very strong housing demand. As we saw, a lot of people, they could work remotely for starters. That really boosted demand. A lot of these markets had come out of a pretty soft run as well, so they were very affordable, at least relative to the capital cities. And then they just went through this boom in housing values, and there was hardly any stock. Values rocketed, probably to beyond what you might describe as fair value in some markets, like Byron is a good example of that. And then a lot of them did see a correction, particularly Byron. Ballina is another good example of a market's down about 15%. But a lot of those eastern seaboard suburbs or regions were also really heavily impacted by flooding through early 2022. So that probably contributed to some of the weakness around northern New South Wales.
And just the other thing which I should have mentioned when we talk about cities, the units versus house distinction. Housing really did a lot better than units, didn't they?
It sure did, like double. If you look at this 5-year growth rate nationally, house values are up about 44%, unit values are up about 20%.
Yeah.
So I think that this really this is a reflection on everybody wanted space through the pandemic. Everybody wanted to have their personal room, probably as part of social distancing and so forth. But yeah, house values just rocketed. Unit values didn't do too much, especially in that early phase of the pandemic. That's actually shifted now. The last couple of years, we've seen a much more aligned performance between the two housing types. And again, I really think that has a lot more to do with housing affordability, just deflecting more demand towards the more affordable price points, but also the fact that the unit market is now going through quite a significant supply challenge. The multi-unit sector has just become really expensive to build in, and feasibility is really challenging for developers to get newly built stock into the market. So I think that's probably supporting some additional upwards pressure across that apartment sector.
Tim, I want to talk more about affordability in a moment, also where we're heading, what the next 5 years will look like. We'll be back in a moment. I'm talking to Tim Lawless from CoreLogic. So we touched on this before the break, affordability in that 5-year period where you were saying housing's up 40%, units up 20%. Wages certainly haven't kept up with dwelling values, have they?
No, they're up like half that, if not even a little bit less than that. Household income's exactly the same. In fact, for a lot of the pandemic, real household incomes, adjusting for inflation, were going backwards. So affordability has been the downside here. For those people that have been lucky enough to own a home, great, that they're a lot wealthier because of it. But getting your foot in the door of the housing market's become a lot harder than what it was, say, in 2020. And you can see that just in, a lot of this, the strength in the market has really moved out to around the mortgage belts. And now, as I mentioned, we're seeing stronger growth in the unit sector. And I think this is really reflecting those affordability challenges where mainstream demand is now probably more able to purchase only around that lower quartile of the market.
What about investors? Are they back?
Yeah, they're back in a big way. They're roughly about 37% of mortgage demand.
Oh, wow.
But the long-term average would be about a third, so about 33%. So they're overrepresented in the market. But just looking at the finance data through the last quarter of the year, or even the second half of last year, investors were clearly starting to slow down. And we can see really clearly investor appetite in the marketplace is really closely aligned with the level of capital gains that are available as well. So I think as we see that ongoing slowdown in opportunities for capital growth, at least over the short term, we probably will see investors becoming less active in the marketplace. It just highlights that that's their main game here in Australia. Investors don't chase yield for property because yields tend to be quite low and they can offset any sort of cash flow losses in a negative gearing sense. They chase capital gain almost exclusively.
Okay. So the report you put out last week talks about the 5 years up to now and the big jump in house prices. The previous 5 years and the 5 years before that were much lower growth rates than the most recent 5 years. What we all want to know, Tim, what about the next 5 years?
Yeah, well, that's
you want to know that too,
isn't it? Yeah, I think the next 5 years will be radically different, to be honest. I think there's a lot of conflicting factors here. We talk a lot about undersupply that's likely to support price growth, but conflicting with that is affordability. If everyone needs a roof over their heads, absolutely, and vacancy rates and rental markets remain extraordinarily tight. But even rental growth is slowing down because renters are just restructuring because they've kind of reached a ceiling on how much they can pay. So I think, looking to the immediate future, 2025, we're expecting the market to be reasonably flat, probably some mild growth, maybe even some stronger conditions in markets that have been a little bit softer, like Melbourne is starting to look like it has some stronger fundamentals despite quite a high taxation base. Hobart as well, values there are down about 12% from their peak. But I think markets like Adelaide, that seem quite overvalued at the moment relative to local incomes, it's probably going to be a marketplace that I'm a little bit more cautious about. Brisbane and Perth, those still seem to have strong fundamentals. But I think the next 5 years will be similar in the sense that it's going to be a very diverse market, and I think punctuated by just affordability challenges, but ongoing undersupply. It's going to be a long time before we start getting a reasonable number of homes built across Australia.
And Sydney?
Yeah, Sydney's extraordinarily expensive. I mean, it's always been Australia's most expensive marketplace, even when you adjust for local incomes, which tend to be higher. To be honest, it's hard to see Sydney values rising substantially from where they are at the moment until affordability starts to become a little bit healthier. What we do expect, though, in Sydney and in Melbourne is probably that upper quartile of the market, the more expensive end of the market, that's probably less sensitive to affordability pressures and more sensitive to changes in monetary policy and interest rates. That's probably where we'll see an outperformance. And we're already starting to see that in the early indicators up to February. It's that upper quartile that really drove the bounce back in the month.
Tim, thanks for talking to Fear and Greed.
Absolute pleasure. Thanks.
That was Tim Lawless, Head of Research for CoreLogic. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.